Question 41. The term disintermediation refers to A. Large-scale withdrawal of funds from savings accounts. B. Mediating disputes between banks and clients. C. Changes in interest rates. D. Obtaining a loan from a savings bank. Correct answer is A. Large-scale withdrawal of funds from savings accounts. Disintermediation refers to the removal of intermediaries in a process. In finance, it most commonly describes the flow of funds directly from savers to borrowers, bypassing traditional intermediaries like banks and savings institutions. Large-scale withdrawals from savings accounts are a consequence or a symptom of disintermediation. The savers seek higher returns elsewhere, like the stock market or direct lending platforms, thus reducing the funds available for banks to lend. Question 42. If a lease contains a condition that an assignment must have consent of the lessor, and the lessee makes such an assignment without the lessor's consent, the assignment would be A. Valid if the lessor does not make a formal objection. B. Voidable as is the lease as well. C. Voidable but the lease remains binding. D. Revocable. Correct answer is B. Voidable as is the lease as well. When a lease requires the lessor's consent for assignment, an assignment made without that consent is generally considered voidable by the lessor. This means the lessor has the option to either accept the assignment or declare it invalid. The lessee, the original tenant, cannot declare the assignment void. Only the lessor can. If the lease explicitly says the lease and the assignment are void if consent isn't given, then voidable, as is the lease as well. Question 43. To commit a misrepresentation, a party must have made an untrue assertion of fact, or ma, which is the equivalent of an assertion of fact. A. Non-disclosure. B. Affirmation. C. Declaration. D. Educated prediction. Correct answer is A. Non-disclosure. Non-disclosure is the failure to volunteer required information. Disclosure is required when a party has offered some facts, but further information is needed to provide an accurate description for the other party, or a relationship of trust and confidence exists between the parties, or a party has access to information not available to the other party. Question 44. The federal income tax is a tax. A. Regressive. B. Progressive. C. Graduated. D. Proportional. Correct answer is B. Progressive. The federal income tax in the United States is a progressive tax system. This means that higher income individuals pay a larger percentage of their income in taxes than lower income individuals. The tax system uses tax brackets, and as income increases, the tax rate applied to that income also increases. Question 45. Fair market value can be defined as A. How much a property is worth, as determined by a broker. B. The price at which a seller will freely sell a property and a buyer will freely buy it. C. How much a property is worth, as determined by the tax assessor. D. The price of comparable properties in the neighborhood. Correct answer is B. The price at which a seller will freely sell a property and a buyer will freely buy it. Fair market value represents the price a willing buyer and seller would agree upon in an open market. This assumes both parties are knowledgeable, acting freely, and without any compulsion to buy or sell. It's a theoretical price representing a balance between supply and demand. Question 46. Buyer Barney made a binding offer to seller Silas that Silas accepted in the proper manner, but then Barney changed his mind and refused to go through with the transaction. Under the statute of limitations, what is Silas's deadline to sue Barney in order to enforce the contract before being time-barred? A. 1 year. B. 3 years. C. 4 years. D. 10 years. Correct answer is C. 4 years. In California, the statute of limitations for a breach of a written contract is 4 years. This means that Silas has 4 years from the date Barney breached the contract, example, refused to go through with the transaction, to file a lawsuit against Barney to enforce the contract. Question 47. Borrower Brian defaults on a scheduled event in his loan agreement, his monthly payment. Lender Lenny then has the right to declare Brian's entire loan balance, all the principal amount still owed, due and payable without delay because of an IA, alienation clause. B. Forfeiture clause. C. Acceleration clause. D. Due on sale clause. Correct answer is C. Acceleration clause. An acceleration clause in a loan agreement allows the lender to demand full repayment of the loan balance if the borrower defaults on any of the loan terms, such as missing a payment. It accelerates the due date of the entire loan. Exercising the acceleration clause is also termed calling the note or the call provision. Question 48. A broker is adverting under the name of XYZ Realty Franchise. The broker's ad must also A. State that he is a licensed member of that franchise. B. Include his own name in the advertisement. C. Mention how many offices the franchise has in California. D. Both A and C. Correct answer is B. Include his own name in the advertisement. Real estate advertising regulations generally require that even when using a franchise or company name, the broker's own licensed name must also appear in the advertisement. This is to ensure transparency and accountability. While the franchise affiliation can be highlighted, it cannot obscure the identity of the responsible broker. Question 49. An option is different from other contracts, such as conventional or conditional sales contracts. The difference is due to what characteristic of an option? A. Irrevocability. B. Mutuality of obligations of the parties. C. Non-mutuality of obligations of the parties. D. Both B and C are correct. Correct answer is C. Non-mutuality of obligations of the parties. The key difference between an option and other contracts lies in the mutuality of obligation. In a typical sales contract, both the buyer and seller have obligations. The seller must convey the property, and the buyer must pay the agreed-upon price. With an option, only the optioner, usually the seller, is bound by the agreement during the option period. The optionee, potential buyer, has the right but not the obligation to purchase the property. The optionee can choose to exercise the option and buy the property, or they can let the option expire without any obligation. This lack of mutual obligation during the option period is what distinguishes it from other contracts. Question 50. Operating a factory on his property, the owner decides to sell the property and then immediately lease the property back from the new owner to continue operating the factory. This practice is called A. Reverse sale. B. Sale leaseback. C. Real property interest swap. D. Such a practice violates the UCC. Correct answer is B. Sale leaseback. A sale leaseback is a financial transaction where a property owner sells their property and then immediately leases it back from the buyer. This allows the original owner to free up capital tied up in the property while still being able to use it. It's a common practice in commercial real estate.